city gas distribution space, these stocks continue to be under pressure. Let's get in Probal Sen, the energy analyst at ICICI Securities, to analyze what next for these names. Probal, good morning. Thank you so much for joining in. Do you think there's a further downside we could see from here on? And what is the outlook now, considering that there's still uncertainty on price hikes? If they do take it, there could be impact on volumes, right? So how do you look at the entire space now?
I think the issue really is the quantum of the cut that has been announced at one go. One has to remember that in any case, the quantum of gas allocation on APM basis is being cut fairly regularly over the last couple of years. If you really go back, it was probably closer to 85, 86% till a year and a half ago. And now it is, it is at about 70%. So a gradual reduction is something that has been absorbed by the companies without it impacting volumes too much, because the differential between CNG prices across major cities and for petrol and diesel continues to be fairly significant at about 38 to 50, even 38 to around 45% as per our calculations. So I think passing it on over a period of time is something that is definitely doable, and we do believe that that is something that's going to happen. Having said that, obviously a 20% cut creates a requirement of around 4 to 6 rupees per kg of hike in CNG to keep the margins at the same level, which may not be feasible to do at one go. And therefore, our sense is that for the next couple of quarters, margins are definitely going to probably remain under pressure for all the three CGDs, less so for probably for Gujarat Gas because of its lower dependence on domestic and CNG for overall business, but definitely for MGL and IGL, there is definitely a pressure that's going to be there. I don't subscribe to the thought process that this can lead to a sector derating, because at the end of the day, this is something that was going to happen maybe over the next probably 12 to 18 months, which has happened at one go. Now, the only caveat here is further allocation reduction in the near term should not happen, because that then obviously puts even more pressure on margins. I think that is something that will need to be seen and monitored. If this is the one-time hike and remains at this level for the next 6 to 9 months, I think that the companies, the CGD companies, can gradually pass it through without hitting volume growth to any huge extent. So that's how we are looking at it at this point of time.
Has it ever happened earlier that the allocation has gone below this 50% mark since the time the APM mechanism has come on board since 2014?
No, not at all. I don't think that we have seen this kind of a level. But then to be fair, the level of 70% was also something that was not seen before the last couple of quarters. So it's something that's been gradually happening. The fact is that this production, the earmark production for APM allocation, is from extremely old fields. And with the introduction of the 20% premium on well interventions rather, even in existing fields, that has come about, pricing for all gas was going to continue to go up. The question really is how fast is the cost increase versus how fast the market can absorb the increase in prices. I think that is something that will be important to monitor going forward. So definitely, the next 3 to 6 months are going to probably see a lot of pressure in terms of earnings. But one will really have to see how these companies pass on the cost increases and how LNG prices fare for the next 6 to 12 months, because that is really the only alternative that these companies have to sort of manage their margins and costs. So I think those two will be key monitorables. But I think the correction that has happened today, I think probably takes care of the kind of impact that one sees. We would remain buyers on Mahanagar gas and Gujarat gas, particularly from these levels.
Yeah, I was just going to ask you that next. What would you do with these names currently? Probal, if you can quickly tell us, is this positive for ONGC now that a portion of gas production would be going there for the Opal Petchem plant?
I mean, frankly, Opal is something that has been seeing, big losses. If memory serves, FY24 also saw them reporting a PBIT level loss of somewhere around 4.5 to 5,000 crore. If I look at their gas consumption of around 4 MMSCMD in total, assuming that they were paying somewhere around $10 to $11 in MMBTU earlier, given that the reliance was on imported gas, that would have been a burden of somewhere around 5,200 odd crores on an annualized basis for gas costs. If they start getting all of this gas at $6.5 to $7, that burden reduces by somewhere, easily by about 2,500 crore. Add to that the
Okay.
fact that they've converted a lot of the debt into equity, and the interest cost burden annualized of, I think, more than 3,000 crore should also reduce to a certain extent. So definitely, I think OPaL can probably see the path to profitability becoming a little bit easier, specifically because on the end product side, they can't really do too much about the pricing softness that continues to be there
All right.
on the petrochemicals.
Okay. Take that point. Thank you so much, Probal, for joining in with your insights. The ONGC stock, by the way, has recovered sharply from the lows as well. So this sector continues to be in focus. As we slip into a short break, a small programming note. As we prepare to ring in the festivities this Diwali, tune into CNBC TV18's Market Movers Forum, 3 p.m. onwards on the 24th of October, featuring guests like Ramdev Agrawal, S. Naren, Nilesh Shah and others to help your portfolio prosper this Diwali.